My first question to you is, what are you itching to buy right now but you can't
Gold.
because things are still a bit abnormal?
Okay, so when I think about what would I buy in the right here and now, I would be buying gold here. It's very clear that the US dollar squeeze that we've seen, you were just speaking about the dollar strength then, is continuing and may continue at least for the next few weeks. Although we can't draw parallels between this situation we're in today relative to 2008 completely, what we can say is that credit does seem to be squeezing, and that's pushed this broad demand for the dollar. What that effectively has done is seen people liquidate any positions they can get US dollar cash from. Gold has been one of them. What I would make the observation is here that the real interest rates in the US have shifted from being negative 0.5 to about plus 0.6 or so over the last week or two. That, of course, has a very negative impact on gold. And, of course, the US dollar, which has a traditional negative correlation with gold, has also been pressuring the yellow metal. So how I would look to this is that this sort of malaise may continue over the next week or two as the Fed continues to do their work behind the scenes. But inevitably we will get some unwind of the dollar strength. And in fact, under the position of additional QE, you should see a weaker dollar over the next 12 months. And also on the back of that, you'll see real rates go back into negative territory. That will be a potent power for gold. So you can see gold again approaching that sort of mid-1600s to 1700 over the next 3 to 6 months. So on the commodity side, that's what I see as a universal long call that can work even in a recovery situation.
All right. So, Wayne, you mentioned about that rush for dollars. It seems like the Fed, central banks have thrown everything and the kitchen sink into providing some liquidity. Is it that the dollar is just going to remain strong for some time? And what ultimately still needs to happen to really bring down the dollar?
Okay, so I think a lot of the squeeze has come from the corporate side on a global basis, as well as from the major banks. So effectively, particularly on the corporates, as we can see, some of the really big corporates, such as the airlines, etc., who have had to draw down on credit lines that they probably haven't had to touch for a very long time. Not only that, but while we had a household balance sheet crisis and I suppose a broader banking crisis in the GFC, this time round, over the last few years, corporates have done a lot of buybacks. They've done a lot of distribution of cash. They haven't wanted to hold cash so much on the balance sheet. Now they've got to return to sort of holding more cash to carry them over this period of what has been very weak demand in Asia and is now transmitting to very weak demand in Europe as well as the US. So we need to start to see those lines of credit, particularly the small to medium enterprises, start to work, and then people will get more confidence that people can hold on until we get through this crisis. Then we'll start to see the dollar turn. Because in the end, people will want to try and seek yield after all of this has happened. And so where is yield highest? It's highest often out in Asia. And so you'll start to see that rotation out of US dollar assets back into Asian assets, etc. That is going to be a powerful force to weaken the dollar.
Yeah, but that's a conversation, I'm guessing, perhaps, and I could be wrong, that we best have when things normalize. What do I do in the next 2 weeks or so when things are still fairly, you have spreads quite wide, you're seeing swaps still kind of blowing out as well. What do I do over the next couple of days?
I think at least in the short term, holding dollar is probably where you would put yourself. So as we talked about prior to the show, we have seen quite a shift higher in the Aussie dollar as an example. Now, I'm not confident yet to be allocating into cyclical currencies. But what we have seen is yield spreads have shifted from being deeply negative in Australia, for example, and now they're actually positive against US 10-year yields, US 5-year yields. And so you are starting to see a yield premium build up there. But for my next 2 weeks, I would continue to sit in the dollar, wait for that liquidity that the Fed is providing to begin to ease the situation, and then you can start to look at opportunities to be working your way out of dollar longs. Also, the point I would make is as well that when we start to look at some of the volatility selling options against some of these really big corporates, like some of the oil corporates, for example, who've been battered down by this sharp decline in oil prices, some of these things are also starting to look attractive, where you would be gathering some of this equity in at much discounted prices, even from where we are today. So they're the sort of things that you would start to do right now, the here and now, until we start to see the dollar squeeze wind its way out.
Yeah, you mentioned about the oil players. You know, what levels are you watching out for crude now? Because it's been so topsy-turvy. And you know, when President Trump said he's going to get involved in this price war, I mean, what can he exactly achieve, really?
Okay, so I'm a skeptical person, I suppose, but I'm skeptical that the oil industry in probably more broadly across the globe, with the exception of US shale, has really felt enough pain yet to bring themselves back together. That is the OPEC Plus group. What I would say is that one of the biggest issues perhaps is not the supply side so much for oil. Yes, we have ample supply, and inevitably we're going to hit tank tops at these sort of levels of supply relative to demand. But the real underlying issue here is what we started with, was the fact that demand is incredibly weak. You know, we look at airlines. Many airlines have cancelled, 80, 90% of their flights. And so consequently, airlines are about sort of the 6, 7, 8 million barrels per day sort of consumers of oil. We consume about 100 million barrels per day a year. So once you take all that out, you begin to see inventories build very, very quickly. And so, yes, you get additional Saudi crude on the market. You get additional crude from Russia and other countries. But in the end, it's actually the demand side which is adding significant crude into inventories. So it's likely that this bit of a bounce we've seen, which was potentially driven by not just this comment by Donald Trump, but also by some comments in the Wall Street Journal around Texas starting to limit production of oil, this bounce is, to my mind, quite short term. I wouldn't be keen to be calling the bull run in oil now, just because we will see this surplus come onto the market in April into May. It is going to be a significant increase in inventories, and we don't expect the demand side, because of the social distancing, etc., that's going on a global basis. We don't expect that demand side to come back yet.